What's up, Gould Miners? Today we welcome to the show Lance Pederson. Lance is the founder and owner of several real estate fund-related businesses, including, most recently, Passive Advantage. Passive Advantage is an AI-enabled tool and software that allows limited partners to assess and evaluate deals more quickly and efficiently. But what is it that has enabled Lance to build so many successful service-based businesses in the real estate fund space? This is exactly what we get into today. We get into the nuts and bolts and really dive deep into Lance's journey, and what we get is an absolute masterclass in real estate funds. Whether you are a limited partner, a passive investor in real estate funds, or if you are a sponsor of real estate funds, there is something in this episode for everyone. We start off by diving deep into Lance's early days as a capital allocator, as he calls it, or nowadays we call it a fund of funds manager. But back in that day, fund of funds didn't even exist. That's how long ago he started helping LPs place capital into great syndications and funds. Later on in the episode, Lance shares some of the secrets and the knowledge that he's gained in helping over 200 funds launch, including his 4-step conversion process for converting any high net worth individual into an investor into your fund. And finally, we spend the latter part of the episode talking about limited partners and passive investors. And Lance dispels some of the lazier metrics that LPs and investors use to judge funds, deals, and sponsorship groups, and really forces you to think about things in a different way as a limited partner and an investor in this episode. With nearly 2 decades of experience in this space and having seen well over 200 real estate funds successfully launched, Lance is a treasure trove of information here. And like I said, whether you are a limited partner passive investor or a general partner in a fund or syndication deals, there is something in this episode for everyone. So without further ado, let's welcome to the show, everyone, Lance Pederson.
The Gould Mine Podcast.
Lance, welcome to the Gould Mine.
Thanks for having me, Danny. Good to be here.
Yeah, this is great, man. You have a really interesting and unique background, and just kind of like prepping for this, talking to you and everything. You described yourself as almost like a fund / syndicator, like middleman between like GP, LP. So walk me through that, because obviously you have to understand, if you're a translator, you have to understand both languages, right? So walk me through how you came to be so well versed and how you were able to understand the language of the LPs really well as the language of the GP. So it definitely is an interesting experience that sort of has led to this. But I think, I got into real estate in 2008 on the private lending side. And in 2011, me and my partners decided to pivot into really running what amounts to a fund of funds, an open-ended fund of funds where we had discretionary capital that we raised from high net worth individuals. So, really our whole strategy was go out, find the best of the best operators in any given real estate, asset class, multifamily, self-storage, office, retail, you name it. And then, vet them, approve them, and then we'd underwrite their deals and then allocate capital into those deals. So in the early days, we were really a super LP, right? So for us, we were like professional limited partners. So that's like my background is like, well, what does it take to like conduct due diligence on a sponsor? How do you vet a deal? So those sorts of things. And then being fund managers ourselves, we're running a fund, we're raising capital from high net worth individuals. Really, so now you're on both sides. We ended up having in what was an accidental business is that as we started allocating capital into various deals, we realized that because we always targeted like emerging sponsors. So these are guys who are, really good at what they do, good real estate guys, but they don't have 20-year track records. And a big pain point for us was that they just weren't very good with the back office stuff, like reporting and financials, and that's where they kind of fell down. So I took an internal department that, administered our fund, made it an external facing division, and we started offering fund administration services for sub-institutional real estate funds. And as part of that, we had a fund advisory practice. So we'd help, guys, architect their funds and, get them up and running and things like that. And
that took off, and it's now, known as Reevaluating. We rebranded in 2017. But so that's the other interesting thing. So you got all these investors coming into these funds. So now I'm like squarely in the middle, man. It's my job and my team's job to prepare the financials and make sure that everyone's doing things, in a fair and balanced, fair and equitable manner. Right. So it's just like, that's really where I've sat, is just kind of in the middle of all of this, right? When you're helping someone architect the fund, I have to think about, okay, what's your strategy? What's the right waterfall and the economics and the fees, with an eye toward what's marketable, right? Like we've got to make, great. You got the world's greatest strategy, but we have to make sure that it's interesting and appealing from an economic standpoint for LPs. And so, helped over 200 guys, and gals architect their funds. That's a lot of conversations, being had, a lot of funds, $3 billion in assets under administration at Verivest. So I've just seen a lot. And so I think that's what has kind of put me in that position, is thinking about, putting myself in the shoes of the LP, putting myself in the shoes of the GP. How do we remove friction from this process so that it just works better?
Yeah, that's interesting. And there's so many ways that I could take this. The one question that I have, or the one thing that kind of sticks out to me, at least at the beginning, is like, you were running a fund of funds model essentially in 2006. This is way before anything like would you say like you were kind of pioneering that model, or walk me through kind of how that was born? Like, what was the birthing of that?
Yeah, I'd say we were. I mean, there definitely wasn't a bunch of other people that were tilting up investment funds to allocate into others, at least at this scale, right? I mean, certainly at the institutional level, it's been going on for years, but to do it where you're raising high net worth money and then allocating into sub-institutional sponsors, no one did that. And obviously now it's a really big segment. I call them, we were capital allocators. That's what I call people who executed the strategy like us. The reason we got into it is because, post global financial crisis, we were very conservative. We were hard money lenders. We're very conservative. I mean, we underwrote the deals, our average loan to value is 55%. We just felt like, rates were coming down and a lot of guys were entering the market, and we just felt like we weren't, it just, the risk adjusted returns, we didn't feel good about it, right? Like, we're not willing to lend, be that aggressive on advance rates and interest rates. So we just looked at ourselves and said, what are we really good at, right? What can be the best in the world at? And we felt like we understand all the complexities of these capital structures and securities laws, and we understand what, we know what a good real estate guy looks like. We know what the people that are good at what they do, how they do it, how they underwrite, how they model their deals. And so that's kind of how we got into it. Like, rather than us picking a specific strategy and being operators ourselves, this will allow us to sort of skate to where the puck is going. And that was part of our thesis, right? Was that, so we went kind of long on multifamily, started like 2014 to, everyone was sort of in multifamily, en masse. And then the same thing, like with, doing conversions of big box retail to self-storage. We got into that, conversions of extended stay hotels into, workforce housing. So we like to have that thematic flexibility to kind of go where the opportunity exists in the market. So that was kind of how we got into that.
Makes sense. Yeah, it's interesting, and I definitely want to spend some time on, your thoughts on how to architect a fund and all of that good stuff, and then we'll get into some of the things that you're doing right now with Passive Advantage and whatnot. But I'm curious, when you were first starting, what was it about emerging sponsors that drew you to them? Is it because you thought, okay, we can get better terms from these guys? Is it easier to kind of establish a relationship at the ground floor as opposed to someone who's a little bit more established? Walk me through the reasoning behind that, because a lot of people shy away from like emerging sponsors. You're like, I don't want to deal with this. I don't want to put my risk. Feels like a lot more risk, right?
Yeah. Well, I think, a few things. One, we felt like, we could just negotiate better terms. And we just believe that when they're emerging, if you pick the right groups, they're going to work really, really hard for you, right? Because they got something to prove. But at the same time, what they lack is they just lack the relationships, right? So like, and most of the guys that we targeted were the ones who really loathe the fundraising process, right? So for them to find a strategic partner who could ostensibly be a big part of that solution, I think it just worked out. Like you take us plus them and you get, a really great end result for all parties involved. And then, because what happens is that the longer you've been doing it and the more you track record, the more traction you get, you can't really negotiate. I mean, you earn the right as a sponsor to charge more fees, right? Like it's like the promote won't be as great. Like we believe that, right? Hey, if you've been doing this a long time, then your experience and the track record is sort of de-risked any deal that you're in. So for us, it just felt like, we did things that others, I don't know how many people do this, but we would negotiate like enhanced information rights. And obviously we're administering, that was one of our things, like we have to administer these vehicles. So we felt like there's ways for us to mitigate the risk that you had with emerging folks where we're kind of doesn't sound right, but the adult in the room, so to speak, of just being able to monitor them more closely, help them make sure they're making good decisions along the way. And it got to the point where we actually were able to negotiate, control rights alongside, as true co-GPs with many of our sponsors. So our whole thing was like, let's grow with them. And at some point, they'll reach a point where maybe they won't need us anymore. And that's fine. That's fine too. So that's how we looked at it. But the key was always just find the guys who are really great real estate guys. And they often come from the brokerage community, right? So they were representing buyers and sellers, and they've been doing it for a long time. They just haven't necessarily been acquiring it on their own for a long time.
Yep.
And we had good success with that. It was a good model and continues to be a good model for my former partners.
It's awesome. And so kind of walk me through, because now you're in the last decade, really, you've had, you said over 200 sponsors that you've kind of helped with in some capacity.
Yeah. So I've helped, guys who come and say, I don't have a pooled fund, I want a pooled fund. I've helped, it's probably 220 of them now go from not having a fund to having a fund that they could go to market with.
What would you say for an emerging fund manager like that? What would you say the three most important, but like overlooked things that you need to have in order to be a legitimate player in like the fund space? Like what are some of the important tangible things that you should have that maybe are like often overlooked?
Yeah, I don't know if they're overlooked, but number one is just you sort of have the tiger by the tail as it pertains to deal flow. So your strategy is very clear in your mind and your ability to source transactions that fit inside your buy box. I think that's a must in order for a fund to work, right? Meaning that you can do enough of those transactions. Some of the other things, that you have to have is, you have to have some amount of maturation where you've been able to get traction, doing syndicated deals. Right. Where, because I always say the same thing, you have to earn the right to manage discretionary capital. Right. So you have to hey, you've syndicated 5 deals, 10 deals, 15 deals in a 1-by-1 basis. But because your deal flow is so strong, it's not the most efficient, effective way to capitalize your deal flow. So I think those are the big things that I look at, because it's certainly more difficult to raise capital into a pooled vehicle because you're asking the investor to completely abdicate the decision making, right? Like they don't get to pick which deals they go into. And then there's just certain strategies that just a fund is really the only way to go. Like private lending would be a great example. If you're originating $500,000, $1 million loans, fractionalizing loans or, finding investors and matching them is just completely inefficient, doesn't make sense. So we had a lot of people who were private lenders who were turning up debt funds as an example. Those are the big things. I always say deal flow is everything, right? So the more clarity you have about how you source those transactions, just a lot of conviction around your strategy. And the more narrow it is, I think it's just easier to raise. If you have a really broad mandate, meaning, hey, we do this and we do this and we do it everywhere, that's not a great formula for, trying to raise money into a blind pool fund.
Yeah, makes a lot of sense. Now, for sponsors of like an emerging fund manager, are you seeing a lot of these guys, or did you see a lot of them that were coming in having never done like the brokerage guys that you're talking about, right? Are they going straight from brokerage to fund management, or is there like a middle step there where they've syndicated a couple of deals and then they're getting into like the fund space?
Yeah, no, they've usually had syndicated a few deals, and a lot of people, you know, the sort of half step is, I mean, there's no one size fits all, right? So this is the other thing I try to explain to people is that the fund is just a vehicle, right? It's just one component of your overall capitalization strategy. So, you know, what one interim step, right, is just to have the pooled fund that's more of like your GP co-invest fund, meaning the fund is only going to represent 10% minimum, 20, 25% of all the equity required to do deals. And you may still continue to syndicate the remainder of the equity. Or you may do, you know, 90-10 joint ventures with, you know, other single large check writers, right? They come in with 90% of the equity and then you bring in the 10. So it's just, that's how I've always looked at it. It's like, it allows you to be more having the fund and starting one sooner rather than later when appropriate, you know, just makes sense. Because the other thing that a lot of people hold against you is like, well, you've never managed a fund before, right? So it's a chicken and the egg problem. Well, I can't invest your fund because you've never been a fund manager. Well, if no one ever invests a fund, how can I ever become a fund manager? So I think that's a better way. Now, you know, and the way that you do that is that you provide those, your friends and family and those who already know, like, and trust you with closer to GP economics, right? So you say, hey, come into this fund and you're going to get, you know, a portion of the promote that we get off of the gated LPs or whatever. That's just a great way to kind of get started. And the fund size might be $5 million for like a real estate operator, or maybe 10 million. So a smaller fund size, but just, you know, just starting small so that you can kind of build that up. Be like, okay, well, we did fund one, get that done, and then do the fund two. And maybe someday you get to the point where all of your LP capital is coming from the high net worth channel and, you know, 100% of the equity, you know, the fund owns 100% of the equity in every single deal you do. That'd be great. But, you know, that you don't start there.
It's so interesting that you bring up the, you know, like the GP2 or like the GP co invest fund structure, because that's something that one of my guests brought up last year, and it was the first time I'd ever heard of something like this. And it seems like kind of like the perfect gateway vehicle into fund management, right? Like, because again, you look at the promotes and GPs are making, I mean, the IRR on the, if you execute the deal right, or even if you don't execute it right, it's just like halfway decent, right? Like the returns are insane. And so it seems like a great way to like incentivize retail capital, be like, hey, like you guys are going to get like really awesome returns if you invest in this, you know, in this co GP fund.
That's right. And it ends up being a different product, right? Because once again, you have constraints, you know, that because you don't need as much. And so now, I mean, you have a scarcity that comes into play, and you're basically saying, hey, existing investors, like, you can come over here, get diversified exposure to the next 3-4 deals that we do. And you're going to get a piece of, you know, of our pie for, you know, for coming in through that door, you know, and then what we did, like in our fund, we said, well, if you invest in our fund, then you get the first look at our syndicated offerings, right? So it becomes sort of a ticket to participate in, you know, we call them co-investments, or the syndicated portion of the equity, you know. And we'd have deals where we would do that. Like, they're a fund investor, we put it out to the fund investors, and then they end up, you know, taking up the rest of the LP equity in the deals. And it never sees non-fund investors, as an example. So
I see.
So there's many ways to do it. It's just understanding and appreciating that there's all sorts of different capital sources. There's certain people that woke up this morning that will never invest in a pooled fund, no matter how experienced you are. They only invest in, you know, syndicated deals, or, right? Like, everyone's got their own appetite. And so it's just having a little bit of something for everybody is just how it works.
I'm really glad that we're talking right now. I feel like I'm gonna selfishly take a lot of this time, because I've got so many questions now, like, as they're coming up for me. One of them being, and this is definitely a selfish question. So one of the, let's say, like main objections that, because right now, just to give you some context, right? If maybe you don't know, raising a fund right now with a couple of partners of mine in the hotel space. So these guys are second generation hoteliers. I'm newer to the hotel space, but I kind of joined them. And so one of the objections that we could keep running up against is this idea that we haven't really had a lot of full cycle deals. And the reason being because like investment thesis up until this point has really been buy and hold, right? So some of these assets have been are over a decade long. So plenty of time for us to have like gone through a full cycle, like exited everything, but like they print money. So like, why would we get rid of them? And so question, like how have you seen that objection like effectively overcome where, the portfolio is large, it's a couple dozen hotels, the majority of them are doing really well. And we just haven't wanted to exit, what's the objection handler there? How do you overcome that?
Yeah, well, the good news is it's probably easier than you think it is. First thing, and no offense to LPs who are listening, right? But it's a lazy argument. And I try to teach against it. When I'm teaching them, I'm like, listen, do I love full cycle deals? Yeah, I love them as much as the next guy, but it's not the be all end all for one of the reasons that you just said. So the way you overcome it, right, is like, okay, you acquire a hotel, it's generating X amount of NOI at time of acquisition. You guys did something to it. And now you go into the future 10 years later, whatever. And now it's producing Y NOI. So what you have to do is you just need to move off of like the whole notion of if success is only that you bought it and sold it for much more than you paid for it, then yeah, you're sunk, right? But that's silly when you say it out loud. Like that can't be. What the job of a value add sponsor is pretty simple when it comes from the real estate side. It's to increase the net operating income or find a way to parcel it out and sell different parts of it, right? So that's what you have to do is that you need to, and I'm a huge guy on like case studies. So take each of those deals and make that deal come more alive for your prospective investors. I mean, it's overlooked by nearly everybody. They're like, we bought this hotel for this amount in this year, and that's all it says. But yet the whole time when you bought it, you had this love affair with each of these assets. Hence why you haven't let it go yet, because you love it. Right. It's like your child. But yet it's like, we're over here talking about, I have 5 kids. So, like, hey, as parents, you always like to talk about your kids. You're proud of them or whatever. And, Johnny's doing this and Jane's doing that and they're whatever. But yet with real estate guys, they don't seem to spend enough time talking about the specific assets and like what they did to them, because that is the object that you've had your focus on. You bought it and it wasn't performing like it should. It had more potential, and you go in and you do stuff to it and you make it great again. Well, share the story. What did you do? What was the circumstances which you bought it? Like, what did you do to it? You made something move. You made it more valuable. Tell me specifically how you did it, and you'll overcome the objection about, full cycle deals. You're walking right into the objection because you're basically giving them a spreadsheet, has a bunch of deals and it has a couple of them that went full cycle. You're walking into the objection. So, what you need to do is you need to change the columns on your track record sheet so that they're saying going in NOI X, current NOI Y, right? And I don't care, apply a reasonable cap rate and, show, do something to demonstrate to them what that means in terms of the value add playbooks you ran, if you were to sell it. I mean, go as far as getting
that's actually,
I don't know, but there's a bunch of ways you can do it.
Yeah, that's actually really, I mean, because I come from the residential world, right? Before this. And like, I mean, we do that. I do that all the time, right? It's like you kind of create like a valuation and then you work backwards. And so, yeah, I mean, like that makes a lot of sense to me. So that's interesting. And that's actually like what you said right there. It's classic sales, right? Like, great. If you know how to sell, you'll never run into the objection. Like if you really know what you're doing, like you'll never experience the objection because you'll have handled it before it even comes up. And in the residential world, I know how to do that in spades. Still trying to Love that.
And that's what I teach a lot of the people like in my training programs, and like it's so much of it is that investment sale, and it's about the pitch, right? So the worst thing we can do, this I say, we don't have case studies, we don't have these things, and we're starting, I call it, we're pitching the packaging, right? We're pitching hey, I give you an 8 pref and a 70-30 split and a 2% act fee, blah, 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 right? Like we talk about like that way more than we should.
Yeah.
The way that I do it is I talk about how we do what we do. I talk about the opportunity. I talk about why it exists. I teach the prospect why this dynamic exists, the scenarios with which we're searching. Why are these sellers willing to sell us these properties? You know, how do we add value specifically? What's our investment process? How do we mitigate risk? What are the biggest risks? How do we mitigate them? Who's the team involved? What makes us different, right? Like I'm pitching the strategy as the product. So it's the we acquire hotels and add value. That's what your product is. Sell that, because you sell that, you're overcoming most of the objections, because now they're getting excited. They can see how you do what you do. And then I pivot to, let me tell you how you can participate with us, but only after I've taught you all the things that we do and how we do what we do, why the opportunity exists to begin with. Then I'll tell you, well, here's how you can participate. And then those terms. And to your point, you've probably answered most of the questions. So the objections are far fewer than they would be otherwise. But yeah. And then the other thing too, is just knowing where you're weak. Like if you know they're going to come right after your track record, then yeah, you've got to be prepared to do things like I said, like just reframe the track record. Don't be dishonest, obviously, but just frame it so that it demonstrates your success. You know, that it demonstrates what you guys have done to achieve these results. You know, I work with a lot of people now who've, you know, unfortunately had a few bumps in the road. Like it's hard when you've been in your business forever and, you know, your track record isn't as sterling as you wish it was, right? And so you always have to play to your strengths. Like what are you great at? Spend way more time talking about those things, and then be prepared to answer the hard questions with thoughtful, honest, genuine responses that demonstrate, you know, and once again, if you did have a misstep, just being able to say, here's what we overlooked. We learned our lesson, you know, whatever the case may be.
Yeah, that's really great insight. And one of the things that I also took away from that is, and I think that I've seen this mistake made because I've looked at tons of pitch decks now, man. I've studied so many fund decks, so many different like multifamily and hotel decks. And the one thing that I feel they all do, and that you just kind of insinuated, was this like feature dumping, right? It's like, hey, you know, there's all these features, and here are the economics, but very rarely are we getting a full-fledged like pitching of the strategy and like telling a story. And so like that's really what you're saying is like, hey, instead of making the feature dumping and the economics the star, that's like the footnotes. The entire deck needs to be case studies, how we've done it in the past. This is our strategy, and this is how we plan on doing it in the future. And like, oh yeah, by the way, these are like the few features and like economics of the deal, sort of thing.
Yeah, that's right. I mean, to get them, because I say there's 4 conversions that have to take place with any high net worth investor. Conversion number 1 is they have to believe that investing in alternative investments makes sense and they'll be better off doing so, right? Because if they're just a stock market person, the answer is no. No matter how great anything you say is, the answer is no. If they're not convinced, the second conversion is they have to understand this. Your strategy has to make sense to them. Like it just has to make sense. Like, okay, developing new multifamily in Dallas, Fort Worth. Convince me why that makes sense. Why would one do that? Or buying hotels and doing whatever. Like you need to sell me on that. Like that's your second conversion. Yeah. The third conversion is, well, now that I understand your strategy, I think it's a pretty good idea. You have to convince me that you're the right team. Like you have what it takes to execute that strategy. Right. And so it doesn't matter how great the deal is. Everyone's going to go back through that process. Okay. Yeah. I already believe in alts. I invested in a bunch of deals. I already understand the hotel game. But now I'm going to be like, are you guys any good at this? Like, can you articulate how do you understand all the inherent risks? Do you understand, what makes you different, right? Like that's what it all comes down to. And if you get those 3 conversions, the 4th conversion then becomes, can I trust you to be a good steward of my capital? And if they believe that, and you get those 4 conversions, whatever you're pitching, whether it's a fund or an individual deal or whatever, the chances of them saying yes then go through the roof. But if you just try to pitch them for the deal straight away, the answer is usually no.
That's really interesting. Yeah, and I love how you broke that down. You call those the 4 conversions?
The 4 conversions
of an LP?
The 4 conversions. Right? Yeah, that's like you have to convert. It's all about creating converts. And if you can't get converts at these 4 stages, and I framed it that way because it's really hard for guys to get, like, they can be like, hey, Lance, I believe in what you're saying. But then I'm like, but you're still not doing it, right? Like you're not doing yourself justice. Like, I'm not saying brag about yourself. I'm saying teach me how you do what you do so that I can see, you can demonstrate to me that you know what you're talking about, right? Like, and you need to appreciate that I might be ignorant to many of these things. So that means that you're going to have to explain some things to me. Like I've got a client that happens to be in Dallas who is doing multifamily development, but they're building, everything's in cold form steel, light gauge steel. So rather than timber. Well, there's a ton of benefits for doing that. Well, the problem is that most people have no idea what the hell cold form steel is, right? Like they don't know what that is. Right. So like, we have to teach you what it is and why it matters and why it's better and why it's cheaper to build and all those things before anything else happens. I have to convince them that, building multifamily with cold form steel is better than doing it with timber, right? That has nothing to do with the sponsor. Nothing. It has everything to do with the strategy, right? Because you could probably convince them that it makes sense, but then if you can't convince them that you're the right guys to build using that innovative material, then, right, like then you're still sunk. So it helps them understand like where are people at. And when you're raising money from high net worth individuals, which is what I think everyone should be, that's the best source of capital. They just don't know. They do something else. They're a dentist by day or a pilot by day or whatever, right? Like they don't know the stuff like we know it, but to assume they do is what causes them they get really insecure because they don't have the confidence. So it's just like understanding and meet them where they're at. Like, let me teach you how we do what we do. Don't be afraid they're going to run out and do what you're doing, right? Like if you've done it right, they're going to be like, wow, that's a lot of work. So there's all sorts of good things that happen when you really get in detail about how you do what you do, because then when they go, 2% acquisition fee, instead of them thinking that's ridiculous, that's so high, they're going, now it makes sense to me now. Like you guys look at a lot of stuff to get one deal done. You've earned it. So that's the name of this game. It's not like other service businesses or something. Like this is people's money. Like this is a high ticket sale. And that means that you need, your messaging and your marketing and certainly your sales ability, right? Because that's why I call it investment sales. You're selling something and you need to know what you're doing. There's better ways to sell stuff than other ways. It's a whole thing.
Yeah, this is a fascinating conversation, man. I think that it sounds like you really understand both sides, like you understand both perspectives, and so you like the 4 conversions. Now I'm wondering, from an LP standpoint, because that's really like a GP sponsor checklist, right? Like, have I executed at these 4 levels? Have I convinced them about alternative investments, or are they convinced? Have we, pitched our strategy in a way that makes sense to them? Have we sold ourselves the right way? And then, have we proven to them that we could be a trustworthy steward of their capital? That's the checklist, right? Now, on the LP side of things, what is the LP version of that? When like vetting a deal, vetting a sponsor, walk me through that.
Yeah, well, I think I came up with the former first. I came up with the latter first, right? So like for me, that was what it was. Like our process, when you think about it, was, I kind of shared it earlier. What did I say?
Yeah.
We want to go. What's that saying? We like certain strategies. Then what do we do? So we were sold on a strategy. Then what do? We went and found a sponsor who could execute it. Right? Are these guys any good at what they do? And then we meet them. We're like, do we trust that these guys can get this thing done? Right. So when you think about it, it's the same process. Now it's called dysfunctional sales practices, right? Like dysfunctional buying practices lead to dysfunctional sales practices and vice versa. So that's a bit of the issue, right? Is that many of the LPs are deal hunting. And that's why sponsors are probably reacting to that. Like, I need to pitch the deal, the highest IRR, the highest equity multiple, the highest cash on cash returns, because that's what they're sensing from them. So that's what I teach the LPs, the same thing. Like, you got to change the way you're approaching this. First of all, you don't know enough about this. You're too ignorant, right? Like, you don't know what you're doing. Okay. So you got to learn. And then don't go worrying about who's got what deals. Go figure out which groups are doing things that are of interest to you, right? Like, have an opinion yourself. You need to have your own thesis. And so I think it's the same thing. It's just, it comes down to, obviously when I'm teaching them, I'm like, you got to read every document, right? Once you get to understand what these things mean, what these terms mean, that kind of stuff. Make sure that you're given access to the financial information. Never invest in someone that's not willing to provide you with, show their work on the pro forma, right? Don't get overcome with the fancy pictures, right? So just like, I'm just teaching the same groups, the same things, just in a different way, right? Like, do it this way instead and you'll have a better outcome, right? Like, I say things like culture. So like, to LPs who don't seem to bring that up on their list, they bring up things like you said, how many full cycle deals have you had? How much skin in the game do you have? I happen to think those two things aren't as important as people think they are. I'm looking at who's building a real company. Who are these individual players? Do each of them, do their skill sets complement, right? Like who woke up this morning is in charge of acquisitions? Who woke up this morning on the team that's in charge of making sure the business plan gets executed? Asset management. Who woke up this morning is in charge of sourcing equity capital? Who woke up this morning, his job to take care of the LPs after you get them? Who woke up this morning to make sure that the financials get done and the K1s get out on time? Like, that's how you just look at it. Do they have a culture? Do they have core values that they abide by? Do they have a mission and a purpose? And do they believe in something? Do they have conviction over their strategy? Right? Those are the things that we looked at, and those are the things that I think other people should look at. And that's what I teach the GPs to do. You don't you have a soulless organization. You don't have no soul. You don't have any culture, right? Like this is you is just buying deals. Like you won't get where you're trying to go. Like, this is a real business. You need to build it out. Like, it's not just, we find great deals, we underwrite deals, and then we execute. It's like, you've got to have marketing and you got to have investment sales. Because I ask a lot of people, like, do you have a sales department? I'm like, sales department? No, we don't have a sales department. I'm like, that's your problem. You should. If you're raising money for people, you should have a sales department. Who are your sales guys? You know? Well, I don't have one. It's me. I'm like, are you classically trained at selling? No. Here's your problem.
Exactly. Yeah.
You're a trader. You're a trader. You're not a salesman. You're a trader. You like to buy low, sell high. That's what you do. So you're not trained as a salesman. Why do you think, can you convince people with your charisma that, maybe you're worth investing with? Maybe, but maybe not. Right. So you need to build a team of actual people who wake in the morning and say, I'm a salesperson. That's what I do.
Yeah. No, I love that, man. And I couldn't agree more. I mean, I definitely, having built a company myself and kind of taking it through the different phases and whatnot, I obviously I don't know everything about the fund space, but I've talked to enough fund managers and I've talked to enough people that are doing this now to the point where I realize, like, I do feel like this space is still pretty immature when it comes to like true business savvy. A lot of these guys understand real estate. They understand how to run the business of their asset class, but they don't understand how to run a business, right? And understand how to run their group like a business. You got departments and everything. Yeah.
Right? And that's my passion. That's why I say, like, what do I do? I mean, I help real estate entrepreneurs grow and scale their investment firms. It's how do you grow and scale a real estate investment firm, right? Which means it's more than just doing deals and, executing your business plan on the asset. There's more that goes into it. If once again, if you want to build and grow and scale a business, right? And that's usually the disconnect is like, guys hire me to help them start a fund or whatever. Like, well, how much are you hoping to do? Well, we want to have $500 million in assets in 5 years or whatever. And I'm like, yeah. I mean, you'll have a legit business. I mean, that means that, like, that's a real business. It'll take a real business to do that. Now, if your aspirations are much lower and you're like, hey, I'll be happy if we buy one deal a year. Well, once again, you have to have a vision of some kind, whether it's a big vision or a small one. You got to know what it
Yep.
is, and you want to build an organization around that. So yeah, I totally agree. And that's where my passion is, like helping them see beyond that. It's more than just doing deals.
Do you use like I don't want to say like a cookie cutter or like a templated approach to the coaching or like I would say when you look at like an org chart, right? Like for example, like have you read Traction before or EOS?
I've been using EOS and Rockefeller Habits since 2000 when I started my first business. So,
dude, hell yeah.
Yeah. So in fact, I mean, you read, so I basically have taken EOS and added to it, I call it Empire Builder Formula. And so I've taken that as a framework for like, here's the framework specifically, the best of, EOS, but with the parts that it doesn't contemplate, because it doesn't contemplate you got to raise a bunch of equity to run your business on an ongoing basis.
Yeah.
Right. So I created all these other tools. So I've got a thing called the magnetic message framework. So it's like, how do you message? Much of what we talked about today, right? Like, here's the process you follow to develop a compelling message. That compelling message then turns into a compelling pitch deck. That compelling pitch deck becomes a compelling website, right? And that becomes compelling collateral and material you use in the sales process, so that your prospects, when they show up on the phone with you, actually know what the heck you do before they show up, so that you can actually focus on how you can help them, right? That's that fourth conversion, the trust conversion. If I jump on a 30-minute call with someone, I'm talking the entire time, how in the world am I ever going to build trust with them? I'm not going to build rapport and or trust in that time. I want them to be like, hey, listen, I don't know if what we do is right for you or not. So I'm going to ask you a bunch of questions. I just need to understand where you're coming from. What are you trying to accomplish? What are your goals? What are your dreams? What are your aspirations? What are you trying to do? What's your net worth? Like, what do you want? Well, now I can say, does what I offer fit into what you're looking for? If not, that's fine. I'll just tell you, hey, you want, 20% returns or whatever. Like, we just don't do that, right? We do core real estate deals. Like, this is capital preservation. It's whatever. I don't have what you want. Things like that. So, anyway, I mean, I love that stuff. I mean, all my successes are distributed because I use those tools. Like, I never would have got where I got if my mentor didn't introduce me to, like, Lance, there's a bunch of wrong ways to run a business and there's a right way to run a business.
Yeah.
You need a plan. You need a strategy, right? You need a vision.
Yeah.
You need core values. That's how you do it. And sure enough, it works if you're disciplined and you stick with it.
Yeah, no, that's super interesting, man. Well, and when I kind of came into this too, like the first thing I realized is like, dude, we need to implement EOS like immediately. We still haven't done it, right? But like very quickly, I was like, dude, this could get really messy really quickly, and we could be spinning our wheels for years if we don't have a system, and so I'm really glad that we're having this conversation, because it's like, it's just reinforcing the idea that like that needs to happen like sooner rather than later.
It does. And a lot of it just comes down to focus, right? Like, you have finite human capital.
Sure.
And probably finite financial capital. And so it's all about determining what the most important thing is, right? What's the one thing? What's the one thing we need to get done in the next 90 days? Right. And everyone's in alignment along those things, because there's so many distractions. That's what I'm saying. Like, it's hard building and growing and scaling a real estate business because it's like you're running two businesses. Right. And I always say, my analogy is like, it'd be like if you owned a trucking company, but you also had to own a oil refinery. Like, if you had to refine the oil to get the fuel to put in your trucks, no one would own a trucking company. But yet we do. We go and like, we have to own like a whole business that like finds real estate, acquires it, adds value to it. And we have to go find the fuel, the capital to put into the deals. That's two different businesses. And we need them to act like they are just one. So there's alignment. And most of them, if they figure it out, their deal side is really strong. Their capital management side super weak. It's siloed. Like it's not right. It doesn't work. So it's tricky. Like, it's not, that's why I feel like this isn't for the faint of heart. Like, you got to love this stuff. If you don't love what you do, then there's probably better ways to make money. There's better things you can spend your time doing. You got to love it.
What kind of marketing have you seen be effective for like post-COVID, right? Because I feel like some of the things that were working pre-COVID and post-COVID like aren't necessarily like one and the same, right? Things have evolved and changed since then. Like, what are the marketing strategies that you've seen be effective in terms of like lead flow? And we're talking funds now. Like, I'm assuming you've got funds that like have 8 figures, 9 figures of of capital raised. So to get to that scale, what kind of marketing have you seen be effective?
Yeah. So, I mean, I think the quickest way to generate leads is paid ads. If you want to reach people that don't know who you are, the best ROI of all is paid ads, assuming that you have someone at the controls that knows how to manage those ad campaigns.
Yeah.
And if you don't, it can get really expensive, right? It's a quick way to lose and waste a lot of money. But that's what I preach. But my whole thing is, like I said, is that wherever we're going to send that traffic to, that's where all this other stuff comes in. It has to be compelling on the other side of it. You paid for their attention. Now you better deliver with something interesting, right? Something that's helpful, that's educational, that's going to, once again, walk through the conversions and those sorts of things. That's what I believe is the best way to do it. Yeah. I mean, there's just, and obviously once you get anyone, like referrals, that was a big one for us. It's just like, once I get one investor, then I got to figure out who they know and find a way to have them, tell their buddies about us. And what we learned was it's a lot safer for them to share with their buddies some educational content. Like, hey, these guys do this webinar that's super interesting, right? Like they're teaching you about things, right? In our case, it was like, how do you conduct due diligence on a fund, a real estate fund? Well, now that's a lot safer. Like, the reputation risk is very low to tell, hey, Steve, we're playing golf. Hey, you should go check this out. You invest in real estate funds? No, I don't. You should check out this thing. These guys do like this great webinar. It's super, helpful and informational and all that stuff. So those are the things that I'm a big believer in. Once you have a great message and a great story and those things are in place, paid ads is the way to go. And then there's a bunch of other that eventually, obviously it's multi-tactic approach is what it always ends up being. Not one will be, the winner, but.
Have you seen, just out of curiosity, have you seen cold email be effective in raising capital from high net worth? No,
never. Maybe in 2012, 2013, but even then, I mean, by that time, it's still, no, I've never really seen it work. It's too intrusive. It just doesn't work. That's why I say paid ads work, because people getting them to like, hey, this offers they're just used to it now. Right. So it's like, hey, that sounds interesting, and they'll give up their email address for that. And they don't find it, for whatever reason, as intrusive. I mean, they'll seem to work, but no, cold email, no bueno. I mean, maybe like LinkedIn sort of it's all the same thing. Like if you go to LinkedIn, like InMail with LinkedIn Sales Navigator, and you're connecting with people, and if you're offering them something of value, right? Like, hey, I've just put together this like comprehensive guide on how to save taxes by investing in real estate or something. That can work. I mean, once again, the number, you got to spend a lot to get a little, but yeah, it's hard. I mean, it's really hard to get this sort of thing going. I mean, going and pitching at like the Money Show or some of these investor clubs or things like that, or, those, once again, if you have something interesting to say and you're differentiated, that stuff can work. If you're just saying the same things everyone else is saying, you won't have much success.
Interesting. Yeah. And I think finding that unique value proposition, right? Like those unique selling points are crucial, right? To have success. Cause I don't know if you feel this way, but I still feel like it's not like a super flooded or congested space, but I do see more and more people kind of like moving into this space. Like it seems like over like the last, especially like 5 years, we've seen a lot more people try to get into the fund space. Oh my Lord.
Yeah, no, it's crazy. There's a lot more people. I mean, the good news is that the barrier, the bar is pretty low. So like, that's what the framework and the processes that I created are designed to sort of unearth and discover. I call them, I just steal right from EOS, right? Your 3 uniques. What are the 3 things when combined make you unique? but it's like, if you discover those things and you're articulating them, there could be someone else who's doing it, but that's the beauty. The bar's low. They're pitching the packaging. You pitch the product, your strategy, and you demonstrate and identify what makes you unique. Like, it's really, right now, it's not that hard to differentiate yourself from others, but everyone's looking at it differently, thinking, no, it's impossible because we all do the same thing. And I'm going, no, but you really don't, right? Like, you really don't. It's that what's really happening is that you've overlooked the things that you do that others don't do, and you're not talking about them. So the best case scenario is they're there, you just haven't identified them, which we're all guilty of, right? It's easier for you to assess me than it is for me to assess myself sometimes, right? An outsider can see things more easily. So I think most of them have it there. And then the beauty, like with my process, it's like, well, it might turn out you don't have anything. There is nothing unique about you, right? You're not differentiated. But now that we've gone through the exercise and you're aware that you're not differentiated, the good news is you can do something about it, right? Like, you can go out and find better ways to source deal flow, tighten up your investment mandate, whatever it might be, right? Just an easy one, be more transparent, like just provide way more information than anybody else provides. So it's just the excuse that, well, we're all doing the same thing, is good for those who don't want to believe it anymore because the bar's low. Take advantage of it. And you start talking about what makes you different, and you're saying things that others aren't saying, and you get in front of investors, it'll work.
We spent probably an inordinate amount of time talking about the GP side of things. And the cool thing is, though, that you have a product service, I don't know what you call it, right, called Passive Advantage, specifically for LPs, right? So tell us a little bit more about that, Lance, and how like an LP could benefit from using something like Passive Advantage.
Yeah, so it started out, my partner's at GI Doc, and he created a spreadsheet that sort of scored deals, right, when he was investing as an LP. And so we connected about a year ago, and he's like, Lance, I've sold a bunch of copies of this Excel spreadsheet, and I really haven't marketed it. Clearly there's signal, there's demand, but he's like, I want to turn it into an online, like, SaaS offering. And so I recruited a couple former DocuSign engineers that are buddies of mine. And so we're launching the online version next month. But the idea is we're leveraging like AI. So, you get all these investment summaries, offering memorandums on deals, and so you can upload the deal. AI goes through and basically tries to find the answers to this series of questions. We built this algorithm that gives certain weighting to certain things. So it's evaluating a sponsor, it's evaluating whatever. And then it kicks out a score in, 4 different areas. An overall score. It's like, this is a 523, right? It's red. Which is sort of the algorithm's way of saying, yeah, it's a riskier deal. Or it's aggressively underwritten, right? Like it's the exit cap is a 4, and right, it really should be a 6. Things like that. So we're just trying to make it easier for them to sort of narrow down like what they should focus on when they are conducting their due diligence. Like, what are the red areas? Like, what are the areas? Now, when you go talk to the GP, what questions should you be digging in on instead of asking dumb questions, right? Asking things like, how many full cycle deals do you have, right? Like, okay, move off of that. Just trust me, there's far more important things you probably should be getting answers to than that.
Yeah. Well, and the full cycle, not to harp on that one, but that one just seems to me like it doesn't make a lot of sense, right? Because like, in order to have a bunch of full cycle deals under your belt, you'd have to have been doing this for several decades now, right? So it's like at least a decade, right? If not more. And so it seems kind of like, to your point, right? Like, I won't invest in an L or a GP that doesn't have a track record, right? Well, if no one's going to invest in me without a track record,
why,
right? Then how am I ever going to get a track record?
It makes it challenging. And that's why I always tell the GBs and the LPs, I'm like, listen, when someone's newer, then it should mean that they're going to share more with you, right? Because that's their way of compensating you for the risk of their potential lack of experience. And so to the GPs, it's like, just don't be greedy. Like, you want to get deals done. Like it's not
Right.
about how much you think you're going to make, because if you never get the equity, you'll
Can we
never
squeeze
make.
off this? Yeah. Can we squeeze out of this one deal? It's like, yeah, man, like pure. Yeah, that's a really, really great way to look at it. I had something in the back of my mind, and then I completely lost it. But oh man, I'm gonna hate myself because it was like
It was
really
it was
important
like
question.
the best question you had. Yeah.
It really was, and I was like, I was this close. Oh well, we might have to save it for the next episode, Lance.
Yeah, there we go.
Have to
Yeah,
save it for
we
the
could
next
talk
one,
for
man.
hours. That's for sure.
No, that's actually like I gotta say, man, like just having you on, everything, it's been great. By the way, if you are listening to this as an LP, like, passive, like, that is a really interesting model that you've come up with, because I think like what it does is it kind of eliminates some of the confusion around, what are the things to look at a deal, especially as a newer LP, right? I think that once you start to get the gist of it and everything, and once you understand, once you've done a couple of deals, you probably have a good idea of what to look for. So that's interesting. And you're also integrating AI into it, which is fascinating. I'd be interested to try it myself. I mean, I would love to just kind of like look at it and even put my own deals in there. Be like, hey,
that's sort of the next, the vision is ultimately that we will have it where sponsors then can, publish their deals, to some sort of directory, and we can match LPs and GPs. And the vision is that we're going to monetize the LP side. Like, LPs, you pay for use of this service, rather than us stepping in and be like, oh, we're going to charge, the GPs. Cause now you've got this conflict of interest, right? Like, we want to be neutral. That's why we're building it. Like, it's an algorithm, we plug in what we think the threshold should be. It's not a buy signal, it's not sell signal. Like, I'm not telling you what to do. It's first of all a teaching tool. It teaches you what these things mean, and what, like, hey, the yield on cost is, stabilized yields on cost is this, and the delta between, like, that's what this means.
Yeah.
And so it's a teaching tool, and it just helps you, be more efficient when you're kind of looking at them. And my hope is the behavior I'm hoping that we can change is just GPs not feeling like they need to be so aggressive to compete with others. I kind of view it as like a bit of the steroid era in baseball, right? Like, everyone's kind of juicing up to pro formas because everyone else is doing it. You feel like if I don't, then I won't ever raise any money. That has to stop, right? Like, I want to reward people being true conservative underwriters, where they're just being like, this is base case. Like, we're not assuming every good thing that could happen will happen. And that LPs conversely are going to be like, yeah, that makes sense, right? So the more the people conservatively underwrite deals, our model basically spits out and says, this is conservatively underwritten, and therefore the score will be higher. It's more accurate, right?
Yeah. I mean, that makes a lot of sense. And I couldn't agree more. I definitely feel like, there are a lot of, pro formas that I would say are more like in the make-believe realm than than in reality, No,
they are.
Yeah.
It's crazy, and it's and I know where it comes from. I mean, I've had all these conversations. I know why guys feel like they need to go there, right? It's just because that dysfunctional buying practices are sort of driving it. But we'll see. It's for us, it's a passion project. It's a lot of fun working with guys I like working with, and so we're looking forward, to getting that launched here in the next month or so.
I did remember what I was going to say earlier, and it wasn't actually a question; it was a comment, and it like finally came back. So I think, and this kind of brings everything full circle, anyways. So I think one of the things that allows you to kind of, I guess, eliminate just in hearing your story and everything. It seems to me like one of the things that allows you to kind of like eliminate some of these more basic questions, so the ones that would usually like eliminate emerging managers, is because you've had a lot of experience in working with emerging managers, and presumably a lot of like good experiences where you've seen, hey, despite like all of like the the associated risks with emerging managers, there's a lot of reasons to actually work with them, and these are the reasons why. And if you can put together a really compelling case study, and really compelling, investment thesis, then you can kind of like mitigate or offset some of the associated risks. So it seems to me, at least, that you have a more holistic view of this industry, whereas, LPs might come in, they're not as educated, they don't really know what to look for. They'll just ask some of these basic questions that eliminate maybe some of the best players or the best funds, the best opportunities that you could be investing in.
Yeah, that's what I think. I mean, we're seeing it now. Many of these really big brand name players with the track records, their deals aren't performing, right? So it just, it's the whole, like, at heart, I'm a teacher. So I've had a lot of seat time. I have a lot of experience, but I love teaching people things, right? I love learning things and I love teaching them. And I think that for me, I use the word ignorance a lot, right? It's just like, how do I help you go from not knowing to knowing? If you're a doctor and you're trying to learn how to invest in this stuff, teaching them these things. GPs, like, here's how you do this, learning how these structures work, things like that. So, but yeah, I mean, you nailed it. It's just like, if we spend more time teaching ourselves, and that's, to you as a sponsor, it works. It like really works.
Okay. Yeah.
Teach people what you know, right? It can, and be, like, that's how you engender trust. Like, you care enough about me to explain something to me and teach me something. I appreciate that. Right. That's what we're doing.
I mean, it makes a lot of sense to me, right? Because that's what all these content creators who are really successful do. Well, some of the ones, right? They're either influencers that kind of like, parade their body around Instagram, or they're actually bringing value to the audience, right? And they're teaching them, and that's how they're kind of gaining their trust. So it makes sense to me, right? It's also, but like, here's the but it's kind of hard work, right, Lance? And so, like, it's hard. It's probably like a slower grind, right? But I think at the end of the day, it sounds like you found it to be way more effective.
Yeah, it's hard, and that's where I say, listen, you're really good at the things you know, so let's just teach people the things that you know. It just so happens to be part of, like, we can make them the same thing, so you're not having to reinvent the wheel. I'm just saying, if like really know self-storage, you really know hotels, teach me what a key is. Like, why do we talk in keys? What do we talk about flags? What is branded, non-branded? Why do certain hotels fail, and, traffic patterns, and right. Like, so I'm just saying that you can do, it's kill two birds with one stone type of thing. Yeah. Right. So that's more of what I'm saying to the sponsors, the GPs, like, I'm giving, it's freedom to just talk about what you do love. Right. Cause I mean, you're a deal junkie. You love this stuff. So I'm just saying, then just create content around that. And that's where I teach people. I'm like, don't try to like cut it all up in different articles right away. I'm like, just spend 90 minutes on Zoom teaching people everything you know about hotels. You can do that, can't you? And if you can't talk for 90 minutes about it, you have to ask yourself, how much do you really understand about that?
You really know.
Right?
Yeah.
But if you start there, then you can go, well, now I can go and use AI tools to cut this up into sound bites. And, the point is just, I'm trying to make it easier for people to get into it and not feel so overwhelmed by this. To your point, like, you don't need to be one of these influencers, like these big real estate gurus. Like, I get it. Like, I'm not asking you to do that. I'm just saying, let's take what you do know. Let's put it out for the world to consume it. And that's your starting point. And then we'll go from there. But we'll just stick within the bounds, the things that you do know. And then you can start to, add other tactics and different things from there. But step one is, if you don't do that, then you just look like everybody else, which means you won't raise money and you won't get to do deals. So I don't know. To me, it seems like a no-brainer. It's pretty important.
Yeah, man, I love it. I've kept you way over time now. And so I want to be respectful of your time. That being said, here we have a tradition that every guest leaves the audience with one final gold nugget. So what's one final gold nugget, Lance, for the audience that they can take home to the bank today?
Oh boy.
Putting you on the spot.
Well, there we go. In spirit of the gold, right? Like, practice the golden rule. Do unto others as you do unto yourself. I think that's the theme of the day. Right? Be more empathetic. Both sides, right? Like, that's the whole thing here, right? It's like our ability to have empathy for others, put ourselves in the shoes of others, leads to good things. That's why it's the good rule, the golden rule, right? You love others as you love yourself. And so I just think you get a lot further in life. It makes it more fun. It's more engaging. It's simple, but I think a lot of us forget it. So there's your gold nugget. It just happened to fit.
Love it, man. Lance, I have a feeling this won't be the last time I have you on, man. And you've been great and would love to continue to pick your brains. So until next time, my friend.
Yeah. Thanks, Danny. Take care.